The Wall Street Journal's James McIntosh joins us now on the phone to talk about it. James, thank you very much for being here with us. Let's talk about whether or not it is justified to make the comparisons between eras like the dot-com bubble and what's happening with markets today.
So I think that there's a general truth throughout history that all bubbles behave in a vaguely similar fashion. And that's true because of investor behavior, fear of missing out, and the slowness to be convinced of change, and then the panic afterwards. And I think that that's a broad commonality across all bubbles. The question is whether this particular one is like any past particular one in more ways. And in this case, really the numbers do look like there were a whole bunch of sectors that shot up, or segments of the market that shot up in the fourth quarter of last year, and then peaked in February, March, and have come down hard since then, which is pretty much exactly what happened, and to the same extent as what happened with NASDAQ. And of course, nothing is ever exactly the same. And if it were exactly the same, we really should worry. But I think there's a very strong rhyme in this bit of history.
So the rhyming is the part that a lot of people are keying on, James. The reason why is because back then it seemed to be very much focused on technology stocks, but then those technology stocks became so big that they became systemically important to the rest of the market. Are there aspects today, in today's market, where we can say maybe cryptocurrency is like that, or maybe the meme stocks are like that? Or is there a lot less systemic risk to the market because of momentum factors today than there were in yesteryear?
Well, I think there's or at least I'm hopeful, let's put it like that there's less risk across the market this time than there was back then. But I am cautious about that. But there are some good reasons. The first is the economy. The economy is just much less reliant. Far fewer people employed in these areas. Consumers stand to lose less because they've invested less than they did back in the dot-com bubble. Less money's gone into things like Tesla and the rest of the sort of clean economy stocks and solar stocks and SPACs and so on. Whilst they've raised a lot relative to the market, they're just much less important than NASDAQ was back in 2000. And then the companies themselves have also raised, whilst again, some of the numbers the dollar numbers they've managed to raise are eye-popping, and much of that money will end up being wasted. You're seeing that with some of the crypto implosions, some of the electric vehicle implosions. Whilst that money will end up being wasted, it's probably not systemic. It just isn't big enough. Whereas back in 2000, every old line company was frantically trying to pitch itself as a dot-com. And newspapers were going out and hiring hundreds of people to set up websites and getting into all these new areas. And whilst there are some examples of that, there's a Chinese property company that set up a car division, for example. These aren't very widespread the way they were back in 2000. So I'm hopeful that the economy won't be hit in the same way by the bursting of these bubbles.
Shepard Smith here. Thanks for watching CNBC on YouTube.